So how do you use a whole life insurance policy as your own bank? This question comes up quite a bit. What we're going to go through in this video is an attempt to answer it in a very, very simple manner. And then at the end of this video, we'll look at a specific example of a policy. So what we'll compare here, just to help simplify things, is what most of us do without a life insurance policy, meaning when we finance opportunities, when we use an actual bank, and then we'll compare that to using a whole life insurance policy. So beginning with no life insurance policy, let's pretend you have an opportunity that comes up. It could be a real estate investment, perhaps it's investing in your business. It's an opportunity, you like it, you need $100,000 of capital to take advantage of this. Okay, now you have, in this example, $100,000 in cash. We can pretend this is in checking or savings, and this is earning 5%. The interest rate could be whatever, depending on what year you're watching this video. But again, we're assuming you've got money in cash, it's earning a return, but you don't want to use this. Maybe you like to keep a certain amount of money on hand, just in checking and savings, or you're looking at this and saying, hey, I'm earning interest here, and if I pull money from my bank account, I'm no longer earning the 5%, and I'm not quite comfortable with doing that. I want to keep a buffer there in cash. Okay, so what you decide to do is borrow $100,000 from the bank for this opportunity. The amount you're borrowing is $100,000. So the bank loans you $100,000, then you pay the bank back with interest. For simplicity, we'll assume that you're paying a 5% interest rate to the bank. Now, when you take that loan from the bank, who controls it? Who sets the terms and the agreements? Do you or the bank? The bank does. So they have an element of control when they're loaning you their money. Now, when the loan is paid back, what happens? What's the benefit to you? Well, now you own the asset fully. So if it was a piece of property, you took $100,000 from the bank in order to acquire that piece of property. When you paid the bank back, you paid the principal of $100,000 plus the 5% interest rate. That's where the bank made money. Depending on how long it took you to repay it, that will determine, or that will have an impact on how much money they made. But this is what happened here. I acquired the asset and I paid 5% all along the way to get that asset. Using a life insurance policy. So how does this work? And this has to do with being your own bank, or how people feel that they can use a policy as their own bank, their own source of financing. So I've got the same opportunity. I need $100,000 of capital. And here, we'll assume you have $100,000 in the cash value of your whole life insurance policy. In this example, also earning 5%. Very important side note here. In order to have $100,000 in cash value, or any amount of money in cash value, we do need to fund a policy in order to build up that value. Meaning I cannot start a policy today with $100 and then borrow against the death benefit. That is not possible. When I am using a policy as my own bank, or like a personal line of credit, it all has to do with the cash value. That's the gauge that determines how much you can borrow against your policy, the cash value. Again, we'll look at an example in a little bit. So you borrow $100,000 against your policy, specifically the cash value for this opportunity. So with this example, you're not going to a bank. Instead, you're using the cash value that you've built up over time. So now you've got a $100,000 policy loan. We'll assume that you pay this loan back also at 5%. The 5% cost to borrow goes to who? The insurance company. Whenever we pay interest on a policy loan, that is money that goes to the insurance company. They do make money in that respect. However, who sets the terms? Does the insurance company set the terms of that loan and state you must pay it back over X number of years or anything like that? No. You set the terms. The agreement, there is no agreement. You can pay it back however you'd like. You've got full control here. And when I say you can pay it back however you'd like, with policy loans, in many cases, you can easily not pay anything back at all. There's a concept with cash value life insurance that involves taking income tax-free during retirement, and how people are doing that, how they're getting income on a tax-free basis from their life insurance policies, is typically they're taking withdrawals, meaning they're withdrawing money, and they're also taking loans and not paying anything back or not paying any loan interest. I say that to illustrate the point that when I take a policy loan, I do not need to repay it. And I like to emphasize that because when you hear the word loan, what immediately comes to mind? Payment and interest. A little bit different or a lot different with a life insurance policy. But main point here, when we pay interest, that rate goes to the insurance company, but you have control. Whereas with a bank, you do not have control. Here's the thing on this, the most important piece. So when the loan is repaid, you own the asset. You actually own it before that, because when you purchase that real estate or invest in your business, whatever it is, at that time you own the asset because the policy is yours. But here's the big thing. And your cash value kept compounding the whole time. So what I mean when I say that is when you borrowed $100,000 against your life insurance policy, a $100,000 loan, you continue to earn that 5% growth rate on the entire amount of money, meaning the $100,000 loan and whatever was left in your cash value. Make sense? Let's look at an example on that, shall we? So what we've got here is an illustration on the left displaying growth, and on the right, we're looking at a loan and then repayment. We're going to make this a little bit easier to follow and just look at the loan period. So here we go, a bit easier. We're going to start in policy year 10. So how much did we fund this policy with? If we go back to the last slide, to the left, you've got growth. This individual is funding $100,000 per year for 10 years. That's a total of $1 million. A nice round number. If you look at this number and say, hey, that's kind of large there, I don't know if that fits my situation, we could take a zero off and everything will perform in a very, very similar manner. But a point we hit on earlier is that in order to build cash value, we need to fund the policy. How much he's funding this policy with is a total of $1 million over 10 years. So by year 10, that's where we're going to start here. You have funded $1 million. Your cash value is 1.1 and you've got a death benefit of 3.15. To the right, same exact illustration, but several more columns. Here's what we're going to look at. How much you borrow against your policy, your annual loan, what your loan balance is, the loan interest that comes due, and then also the interest payment and principal payment. And what we'll look at specifically is when you take a loan, what is the impact on your cash value and your death benefit? And this all revolves around how people feel that they're using a policy as their own bank because they've got control and their money keeps on compounding for them. So let's take a look here. We take a $1 million loan against the policy. Before we take that loan, actually, what are your cash value and death benefit figures in both examples? They're identical. There's no change there because we haven't touched the money. Now, when you take that $1 million loan, what happens? Let's look at the next year, when you're 50 years old in this example. Your cash value grew from 1.163 to 1.209 million. So you've got a little bit more than $40,000 in growth and you paid nothing into the policy that year. So keep that figure in mind along with the death benefit. See that? Scroll your eyes to the right and look at your cash value and death benefit. What happens here? They're less. Why? The reason why is because you took a policy loan of how much? $1 million. Whenever you take a loan against your policy, whatever you have in cash value is the equity that you have access to. So if you said, what's the maximum amount I can borrow? It's whatever your cash value is. Typically, it's going to be right around 95%, might be a little bit higher or lower than that, depending on the company and how your product is set up. But that's a safe number to go with, about 95% of your total cash value. So you borrow $1 million, what happens to your cash value? We see it drop. What happens to your death benefit? We see it drop. How much do the figures drop by? The amount you borrowed when you look at it. Before the loan, your cash value was 1.209. After the $1 million loan, the cash value is 209. it's $1 million less. The death benefit was also collateralized dollar for dollar. So what that means is if you die with a loan outstanding, the net death benefit that's paid out is right here. It's whatever the total is minus the outstanding loan. So what we're going to do next is pay the interest annually and then apply $100,000 per year toward the principal. Now you can pay it back however you want. The purpose of this illustration is to demonstrate what happens to your cash value and death benefit when the loan is repaid. What do you notice here? Example to the left, where you just let it sit and grow. Cash value has appreciated to $1.8 million. Death benefits 3.5. In this example, when the loan's paid back, there's your cash value and death benefit. Are those values any different? No. It's fully restored to what it would have been as if we never touched it in the first place. We receive that constant compounding all the way through. This is where people view a policy as their own bank or as their own financing tool. A lot of people express it's like a personal line of credit. It's all the same thing. The cash value continues to compound over time, gets bigger and bigger, and I know that I can borrow against that cash value while my value continues to compound. So now when I acquire other assets, instead of going to a bank and paying them interest, I can borrow against my policy, pay the insurance company interest, but what they're paying me, remember they're still paying you dividends and interest on the full amount that we've got to the left. That's going to offset the interest I pay them in a sense. If you're very technical, what we like to do is look at how much we've gained from the company compared to how much we've paid them. We've got videos that go through that in detail. But my point is, my money keeps on moving forward. I can acquire other assets, and then once I repay the loan, I see my value restored, plus all of the interest I've earned all the way through. So I hope that you enjoyed this video. I do hope that it makes sense. Let us know if you have any questions or comments. Feel free to leave a comment below. And if you would like to connect with us, if you are interested in a whole life insurance policy, you can visit our website, ibcglobalinc.com. And what I'll close with is people that work with us are looking for whole life insurance policies that are set up for maximum cash value, but really they want to make sure that everything is done right. And that has to do with the initial setup, choosing the right company, and then receiving ongoing guidance and support with respect to using their policy for something like this, loans. So again, I hope this helps. Thanks so much for watching all the way through, and we will talk to you soon. Bye for now. Hey guys, Steve here with IBC Global. Thank you so much for watching the video. If you're interested in a whole life insurance policy and you'd like to work with our company in setting it up, please visit our website, ibcglobalinc.com. We would love to work with you. If you have any questions, please leave them in the comments below. And as always, I hope this helps.